September 15, 2008, Monday morning, 1:45 a.m. One phone call and 158 years of history disappeared. Lehman Brothers, a firm that survived the Civil War, 2 world wars, the Great Depression, the dot-com crash, every storm the system had ever produced, filed for bankruptcy. $619 billion in debt, gone. 25,000 employees walked into their offices that morning, and their security badges didn't work. Investors who were told just 8 months earlier to buy the dip watched their shares fall from $86 to zero. Not down 50%, not down 80%, zero. Take a moment and slow down, because this isn't just a story about collapse, it's a story about how fast certainty can turn into nothing. And here's the question I want you to sit with for the next 10 minutes. And while Lehman Brothers was collapsing to zero, something else was rising. Because in financial physics, nothing just disappears. It transfers. That's the rule no one teaches you. Go back through history, 1929, 1987, 2001, 2008, 2020, 2023. Every banking crisis ever recorded follows the same pattern. While some assets are completely destroyed, others quietly preserve value, or even make fortunes for those who understand the shift. Listen carefully. Today, I'm going to show you exactly 5 assets that survived every major banking crisis in history. Not theories, not generic advice like just buy gold. Real assets, with real performance. Real dates, real data. And more importantly, I'm going to show you what went to zero, and the precise psychological trap that kept smart, educated investors holding those assets all the way down. Because this isn't just about what to buy. It's about understanding why people lose everything, even when they should have known better. Take a moment and slow down. By the end of this video, you won't just have information. You'll have a framework, the same one financial historians took decades to uncover, to protect your wealth when the system starts to shift again. Let's begin. Listen carefully. Before we talk about the 5 assets, you need the framework, because survival doesn't mean no drawdown. Some assets fall hard first, then do something extraordinary. In every banking crisis, there are only 3 types of assets. Type 1, assets that go to zero. These are built entirely on trust and leverage. When trust breaks, value doesn't decline, it disappears. Bank stocks in crises. Mortgage securities in 2008. Layered derivatives built on fraudulent debt. The moment belief collapses, they become worthless. Type 2, assets that crash, then recover. Down 30%, 40%, even 50% in panic. But underneath, real value remains. Blue chip equities, prime real estate, investment-grade bonds. Painful to hold, but they survive. Type 3, the rarest. Assets that hold or rise while everything else collapses. To find them, I studied nearly a century of crises from the Great Depression to the 2008 financial crisis and the 2023 banking panic. And here's one of them, U.S. Treasuries. September 29, 2008, 2 weeks after Lehman Brothers fell. Panic everywhere, stocks collapsing, and then something extraordinary happened. Treasury yields went negative. People paid the government just to hold their money. That's not investing. That's fear, turning into a system-level signal. While industrial stocks were collapsing and banks were failing, those holding U.S. Treasuries got their money back, plus profit. In just 3 months of 2008, Treasury bills nearly doubled in supply as global capital flooded into safety. This is what's called a flight to quality. Because in a crisis, investors stop asking, "How do I make money?" They ask, "Will I still have money tomorrow?" And the answer for institutions, governments, central banks is U.S. Treasuries, backed by the full faith of the United States. The issuer of the world's reserve currency with the unique ability to print what it owes. But understand this. Treasuries protect against banking crises, not inflation. In 2022, when inflation surged and the Federal Reserve tightened aggressively, long-term bonds lost nearly 30%. Different crisis, different outcome. Now here's what most people never expect. Not stocks, not crypto, not real estate broadly. Farmland. In 2007 to 2009, while the S&P 500 fell over 50%, U.S. farmland returned nearly plus 30%. Why? Because food demand doesn't collapse. Land can't be manufactured. And farmland doesn't move with financial markets. While the system panics, it keeps producing value. Farmland doesn't just survive crises, it often moves in the opposite direction. It's one of the few true diversifiers, and one of the cleanest inflation hedges. Because every banking crisis ends the same way, money printing. And when currency is diluted, food prices rise, farm income rises, land values follow. For decades, farmland has outpaced inflation by a wide margin. But don't romanticize it. The 1980s farm crisis proved something critical. When farmers over-leveraged at peak prices and Paul Volcker pushed rates to 20%, farmland collapsed. Not because the land failed, but because debt did. Same asset. Different outcome. Leverage is the variable. Now shift your focus. Silver and precious metals. In October 2008, silver crashed over 50% in weeks. By April 2011, it surged to nearly $50, a 400% plus rebound. This is the pattern. Phase 1, panic selling for liquidity. Phase 2, realization, money printing, bailouts, currency debasement. Phase 3, acceleration to new highs. Gold held. Silver exploded. Why? 3 words. No counterparty risk. Stocks depend on companies. Bonds depend on issuers. But metals exist outside the system. Every financial asset you own depends on someone else. Stocks only have value if the company survives. Bonds only work if the issuer keeps paying. Cash in your bank account only matters if the bank stays solvent. But physical gold and silver, they don't depend on anyone. No government promise, no institutional backing, no counterparty. They exist with intrinsic properties recognized for over 5,000 years. And no banking crisis has ever changed that. But understand this clearly. Precious metals are not growth assets. They don't pay dividends. They don't compound. In the 1990s, while equities surged, gold went nowhere. So don't confuse the role. If you want growth, own businesses. If you want protection, own metals. Now let's talk about gold. Not as a commodity, but as money. In 1933, during the Great Depression, gold was revalued overnight, up nearly 70%. In 2001, while tech collapsed, gold began a decade-long 600% run. In 2008, while the system broke, gold still finished the year positive. In 2020, during the fastest crash in history, gold hit new all-time highs within months. Same pattern. Every time. Because gold isn't reacting to crisis, it's reacting to the response. Money printing. Currency debasement. Loss of trust. And here's what most people miss. Central banks, the ones who create money, are buying gold, not selling it. So when the system shakes, gold doesn't ask for permission to hold value. It just does. The purpose of gold is for the day your system fails. The day employees at Lehman Brothers walked in and their badges didn't work. That's protection. But now, here's what will change how you see investing forever. The number one asset in a crisis isn't a commodity. It's not government bonds. It's not even something you can hold. It's businesses that sell what people cannot stop buying. Think Procter & Gamble, Johnson & Johnson, Walmart, Coca-Cola, Nestlé, Unilever in 2009. While the world was collapsing, these companies kept selling soap, diapers, toothpaste, food. Not growth, not collapse, stability. While the S&P 500 fell 38.5% in 2008, consumer staples dropped far less and recovered faster. Why? Because demand doesn't disappear. People stop buying luxury, they stop traveling, they cut spending. But they don't stop eating. They don't stop buying medicine. They don't stop taking care of their families. That revenue stability is the rarest asset in a collapsing system. It allows these companies to keep paying dividends, keep investing, and come out stronger while everything else fights to survive. These companies don't just survive crises, they exit stronger than when they entered. Because when capital flees banks, tech, and cyclicals, it has to go somewhere. And it flows into stability. Consumer staples become a magnet for institutional money, not because they're exciting, but because they're reliable. Now here's the deeper insight. Gold stores value, but it just sits there. Consumer staples do both. In good times, they grow, revenue expands, dividends compound, wealth builds. In bad times, they defend, falling less, recovering faster. That dual function is rare. Over decades, that difference compounds, surviving multiple crashes with smaller losses, continuous dividends, faster recoveries. It adds up to outperformance. But don't misunderstand this. They're not immune. They still fall. They can be overvalued, and bad companies still fail. Now, here's the part most people miss. Crises don't destroy randomly. They follow a pattern. Lehman Brothers, Bear Stearns, Washington Mutual, Silicon Valley Bank, all strong before they failed. Recommended, rated, approved, and then zero. Because hidden leverage always reveals itself, just not until it's too late. And here's the rule. If you can't explain how something makes money, it's not sophisticated. It's a warning. The system doesn't fail all at once. It fails in layers. Enron looked perfect until it wasn't. Billions in hidden debt, buried in complexity. Executives knew, auditors ignored it, and when truth surfaced, $90 became zero. WorldCom followed. Same illusion, same ending. Now zoom out. Weimar hyperinflation, where money itself died. Trillions of marks, worthless. Bonds, gone, savings, gone. But farmland still produced. Gold still held value. Essential businesses still sold. This is the pattern across Argentina 2001, Zimbabwe 2008, Venezuela 2016. When governments print without limits, currency collapses, and anything priced in that currency collapses with it. .com bubble? Same structure. Pets.com raised millions, had attention, had a story, but no real business. 9 months later, zero. Crypto 2022? Hundreds of tokens, zero. No revenue, no intrinsic value, just belief. So here's the principle that ties everything together. Assets that survive crises have value independent of the system. Farmland grows food. Gold exists. Silver functions industrially. Consumer staples generate cash flow. U.S. treasuries are backed by the core of the system itself. But assets that fail, they rely on trust. And a banking crisis is simply the collapse of that trust. So ask yourself this, and take a moment with it. If the system disappeared tomorrow, would this asset still have value? If the answer is yes, it survives. If the answer is no, it goes to zero. That's the framework. You don't need to predict the next collapse. You don't need to time the market. You just need to own what survives, and avoid what only works as long as people believe it will, because one day something will break. And when it does, the difference between those two becomes everything. If this gave you clarity, share it, because real financial understanding is rare. And I'll see you in the next one.